Energy prices have surged over the last week as tensions in and around the Persian Gulf escalated into active military conflict between the United States, Israel, and Iran. The US undertook its biggest military buildup in the region for over 2 decades, culminating in coordinated American and Israeli strikes on Iranian territory. Iran then promptly responded with missile attacks across the region. This included strikes on US military assets located in several Gulf states and key targets within Israel. Airspace closures, maritime warnings, and emergency security measures are now in place across much of the region. Shipping companies are suspending voyages as tankers come under attack. Insurers are withdrawing their war risk coverage, and hundreds of vessels are now anchored around the Strait of Hormuz, as shipping decisions shift from commercial calculation to basic security considerations. What's more, this is all feeding directly into global markets. Both oil and gas prices are spiking as energy supply from the Gulf remains cut off from global markets and as major energy assets in the region come under attack. Shipping costs have also exploded as tanker freight rates climb to record levels, while insurance premiums for voyages in the Gulf continue to soar. Equity markets are now becoming more volatile, while bond yields are rising over renewed inflation fears. At the very core of these shocks sits the Strait of Hormuz. A massive 1/5 of global oil supply passes through the strait before reaching global markets. A hefty chunk of global LNG exports also transits this narrow waterway. But the strait is not the only factor driving markets. Prices are now embedding multiple layers of risk all at once, including transit disruption, the damage to regional energy infrastructure, a major breakdown in shipping and insurance, and the very real possibility that a prolonged conflict removes a significant share of supply from global markets. As for what happens next, we first need to understand how markets respond when the critical choke point of Hormuz becomes stressed, how energy systems adjust under disruption, and how the likely decisions of major powers will ultimately determine the duration of this conflict. The Strait of Hormuz sits between Iran to the north and Oman and the United Arab Emirates to the south. Tankers carrying crude from major OPEC members including Saudi Arabia, the UAE, Iraq, and Kuwait must pass through this corridor before reaching global markets. Large volumes of LNG exported from Qatar also transit the strait, making it crucial to global gas supply and electricity generation across much of Asia and Europe. Some of the world's biggest energy importers, such as China, India, Japan, and South Korea, depend heavily on supplies passing through this corridor. With the strait narrowing to just 20 miles at its tightest point, the global energy system exhibits structural fragility at this confined channel. Alternative export routes do exist. Saudi Arabia operates pipelines that move crude to the Red Sea. The UAE also has a pipeline running to the port of Fujairah. But when compared to the gargantuan volumes that move through Hormuz, those substitutes can only realistically offer limited capacity. This is why oil and gas prices quickly surged even before physical supply was being removed from the market. Markets initially rallied even just on expectations of a future closure of the Hormuz Strait. Previous periods of heightened Gulf unrest were all accompanied by pronounced rises in Brent futures prices, despite the strait remaining open throughout. The tensions over the Iranian nuclear program in 2012, the tightening of US sanctions against Iran in 2018, and the brief but intense 12-day war between Israel and Iran last year all saw markets rally without any supply loss from Hormuz transpiring. But with the Strait's confirmed closure in recent days, hundreds of tankers shipping energy to the world are currently stranded or idle in the Gulf. This is triggering a material disruption in global energy supply, which is sending prices skyrocketing. To amplify the situation, shipping companies are now suspending multiple voyages. Some vessels are waiting outside the Gulf rather than entering the Strait, and major insurers are now widely removing war risk coverage for tankers operating in the region. All of this is making commercial transit far more difficult. Plus, the conflict has now expanded well beyond maritime risk. Missile strikes have targeted military infrastructure across the region, and credible reports continue to emerge of attacks materially impacting the energy infrastructure of Gulf producers, including major refineries in Saudi Arabia and Qatar. Even when facilities remain operational, the mere threat of further strikes is forcing operators to reassess security and production plans. Insurance markets have also reacted rapidly. War risk insurance coverage normally protects ship owners against losses caused by the likes of missile strikes, mines, vessel seizure, and many other acts of hostility that could impact tankers operating in conflict zones. With tensions in the Gulf rapidly escalating, insurers are now raising those premiums to reflect the growing likelihood of such losses. Even a small rise in premium rates for a very large crude carrier can add hundreds of thousands of dollars to the cost of a single voyage. And with some insurers even withdrawing coverage entirely for shipping activity in the Gulf, ship owners are reassessing whether or not to send vessels into this region at all. This is prompting a major shift in shipping economics. The Baltic Dirty Tanker Index tracks the cost of chartering crude oil tankers. It clearly shows that freight rates have risen sharply since late February. This is because ship owners are now demanding more compensation to operate in this high-risk environment. Reports of sharply declining availability of vessels are also supporting higher freight costs, with some operators now avoiding the region entirely. These rising costs are boosting the delivered price of oil and refined fuel. With refiners having to pay more to deliver crude from the Gulf, it means that end consumers will ultimately face inflated prices for their fuel consumption. Now, you might be wondering whether any of the lost energy supply from the Gulf can be easily replaced. For one, we can look at global spare capacity, which represents the ability of energy producers to boost production within a short time frame. That capacity is estimated at around 4 million barrels per day globally, much of which is housed in OPEC countries such as Saudi Arabia and the UAE. But with a whopping 20 million barrels of oil transiting the Strait of Hormuz, current spare capacity estimates fall well short of replacing the region's supply shortfall. Can existing oil inventories help in this situation? Global crude supply has been consistently running ahead of demand in recent months. According to the International Energy Agency, this imbalance has created a sizable surplus in commercial stocks of oil at a size not seen since 2020. This excess could act as an important shock absorber against the immediate market rally. But while such a buffer might buy some time, it does not eliminate risk, especially if shipping through the strait remains restricted for several weeks or months. Speed also matters greatly. Bringing additional barrels to market is not an instant process. Production must be ramped up, infrastructure must be activated, shipping must be arranged, and buyers must be secured. The situation for natural gas is even less flexible. Unlike oil, global LNG supply cannot easily expand in the short term. Liquefaction capacity is essentially fixed, while new export facilities take years to build. These mismatches explain why markets have reacted so strongly to disruption risk in the region, and why gas prices are exhibiting even more volatility than oil. It essentially means that energy prices are focusing less on the ability to replace supply and more on how long the supply disruption might persist. Perhaps even more concerning is that this shock extends well beyond commodity markets. With oil and gas being globally traded in US dollars, higher prices are quickly transmitted into greater demand for dollar liquidity across the world. This means that importing countries must be in possession of more dollars so they can pay for their increasingly costly energy purchases. That extra demand can strengthen the US dollar at the same time that geopolitical uncertainty pushes investors towards dollar-denominated assets as a perceived safe haven. This is why global demand for dollars often rises when energy prices rally and drives pronounced gains in the US currency. But this dynamic is particularly troubling for emerging markets, where governments and corporations widely borrow in dollars rather than in their own currencies. When the dollar strengthens, those markets face rising costs to service that debt. They also face more expensive imports. Local fuel becomes less affordable, potentially prompting governments to subsidize energy prices and thus place additional strain on fiscal balances. And if central banks have to raise interest rates to stabilize their currencies, growth in these economies can be significantly dampened in the long run. In other words, an energy shock originating in one region of the world can propagate throughout the global economy. That also includes developed economies, which are far from immune from the impact. Higher energy prices erode household purchasing power and compress corporate margins. Transportation costs rise, industrial raw materials become more expensive, and businesses may even delay investment or hiring if they face consistently higher energy bills. This transmission can also be instrumental in causing the inflation rate to accelerate. Crude prices feed directly into the cost of transport fuels, aviation fuel, and shipping budgets. Gas prices influence electricity generation, heating costs, and industrial energy consumption. Those higher costs then filter deeply through supply chains. Transport companies have to pay more for fuel. Manufacturers face higher costs for petrochemical feedstocks and energy-intensive production processes. And retailers face rising outlays when dealing with logistics. Over time, those swelling costs appear in consumer prices. And should spikes in energy prices persist for long enough, they can influence expectations about future inflation as well. Bond yields may then rise as investors demand additional compensation for inflation risk. Equity markets can also become more volatile, and credit conditions may tighten as investors reassess corporate risk. Central banks then face a difficult policy dilemma. While a rate increase might help to control inflation, it pushes up borrowing costs and subdues the outlook for economic growth. Should monetary policy be eased instead, the risk of elevated long-term inflation goes up. The challenge for policymakers becomes determining whether the shock from this conflict is temporary or whether it's sustained. A brief disruption in energy flows will produce a short-lived spike in prices that should fade as supply stabilizes. But a prolonged conflict that keeps shipping disrupted or keeps energy infrastructure under threat could sustain higher prices for months. In fact, it is the duration of the conflict that will ultimately determine how markets in the global economy play out, especially when it comes to the Strait of Hormuz. Disruption in this vital energy corridor is taking place through a combination of actions that is making commercial shipping too dangerous or too expensive to continue. Missile strikes near shipping lanes, the naval harassment of tankers, the mining of key transit routes, and insurance withdrawal can all make voyages commercially unviable. This creates a situation where disruption does not require a complete blockade. Limited strikes, threats, or incidents can be sufficient to raise insurance costs, deter ship owners, and slow tanker traffic. But the sustainability of such disruption is limited by key constraints. For one, missile exchanges and air defense operations can quickly consume resources. Interceptor missiles used by air defense systems are expensive and finite, and sustained high-intensity exchanges typically place growing pressure on available stockpiles. Offensive missile inventories are also limited. Launching repeated barrages over extended periods requires ample reserves and reliable production capacity. And continued strikes on vulnerable infrastructure, such as energy facilities, ports, and military installations, will not only escalate the conflict, but will also raise economic costs for all parties involved. And those costs matter for Gulf producers, who rely heavily on export revenues. A prolonged disruption that severely restricts shipping would severely limit those revenues and place considerable pressure on government finances across the region. At the same time, energy importing economies face the prospect of rising costs and slower growth. Simply put, continued disruption imposes painful economic costs on both producers and consumers. So, the key variable is not simply whether disruption is possible. It is how long escalation can continue before those constraints begin to force de-escalation. Because duration ultimately determines whether the current situation triggers a short-term market shock or a sustained global economic event. If you found this analysis useful, consider subscribing to this channel. Here at Markets in Power, we examine how the crucial decisions made by governments, institutions, and geopolitical actors shape global markets and the broader economy. Because markets rarely operate in isolation. Rather, they move within the structures of power that surround them. Thanks for watching, and I'll see you in the next video.